doing? Hello, welcome back. You're listening to the Royalty King, and you're listening to a royalty king in disguise. He doesn't know it yet, but he's going to turn into a royalty king. Just give him about a decade, I think. My guest today is many things, actually. He's a recovering academic. He's a professor of finance. He's the descendant of nobility. Not a lot of people know that. He's a consumer of yerba mate and a consumer of Vegemite in the making. It's Steve from the Unemployed Value Degen. Guys, if you enjoy these deep dives into misunderstood businesses and capital-light business models, make sure you hit the subscribe button. That really helps in terms of allowing people the opportunity to find these conversations. And without further ado, monsieur, we are going to touch on specifics today. That's what people want from you, Stephen, apparently, according to my news feed or question feed. They want to know about Opendoor technology, LifeMD, and have you ever heard of a company called Abacus Life by any chance?
Never heard of the thing. Only have eight
Well,
write-ups on my
we're going to leave
Substack.
your victory lap for later, sir. Let's start off. Your choice, dealer's choice of Opendoor technology or LifeMD. What do you want to start with, sir? You're the guest.
Well,
leave it to
I
you.
like LifeMed, but I think my own convictions. I think mortgage origination is one of the places to be in the U.S. You've got a president that was a former real estate developer who's doing everything possible to bring rates down, to bring spreads down. He's having government-related agencies buying $200 billion of mortgage-backed securities. He's getting a new Fed chair in, I think, 2 months. So I think for the rest of this year, I want to be accumulating all the mortgage originators.
Okay.
One of them, I had written about June of 2024. I wrote about why Opendoor has the potential to be $1 trillion company.
All right. Now I have to be a good journalist type and ask, okay, what makes you say that? What is the opportunity for Opendoor Technologies?
So housing is a $2 trillion annual marketplace. $2 trillion changes hands every year. And it has a market structure that allows for a winner take all. Like Uber with taxis, the drivers want to be on the platform with the most riders, and the riders want to be on the platform with the most drivers. And it makes this self-reinforcing feedback loop that the horse in the lead gets a boost, gets a benefit, right? So the winner keeps winning more and more and more. So that market structure, it's not in every market. So, for example, we're going to talk also about LifeMD, which is a competitor to Hims and Hers. And, there's no self-reinforcing feedback loop. You don't need to be on the same platform to buy Viagra as your friends. You don't need to be on the same platform to buy your Rogaine with minoxidil as your friends. You could have 100 platforms. It just doesn't matter because there's no self-reinforcing feedback loop.
Yeah, everyone's just got their local gym trainer. Otherwise,
Yeah,
a trip to Mexico.
exactly. So the housing market, because you have people listing homes and people buying homes, right now there's currently a market dominant platform. It's created by the National Realtors Association, National Association of Realtors, and it's called MLS. It's a listing service, I think. That's where most houses are listed. But there's room there for a platform to have unique listings, and then unique buyers come for the unique listing. So there's room for a platform to come and to really take all in that marketplace. There's room for an Uber to take 95% market share. And so that means that whoever wins that market, they can get the whole thing, and it's a $2 trillion market. And the other thing that's interesting about Opendoor is there's almost no competition. Zillow lost $900 million. They lost almost $1 billion, and they gave up on it. They said, we'll never do this thing again. That was stupid. Redfin lost about $50 million. They said, we'll never do it again. That was a mistake. That was stupid. It wasn't that the business model was flawed. There was definitely a learning curve. But Opendoor is kind of like a race of one horse. And if that horse succeeds, then they get the whole prize. They get the whole $2 trillion market. And the odds of succeeding just went way up because they got a superstar management team. So when I first wrote about Opendoor, the original founders took it public via a SPAC right at the top of the market. Chamath was very smart at selling his SPACs right at the top of the market in 2021. getting the most money you could possibly get for it. But when interest rates rose in 2022 under Jerome Powell, they were like, this is not going to be fun for a while. So all the original founders left the company in the hands of these sort of bureaucratic managers. I talk about this a lot, looking for insider buying, looking for founders, trying to find companies that are run by people with founder DNA that really believe in it. Because most management teams are just a bunch of bureaucrats. They've got bureaucrat minds and they do bureaucrat things.
For owner operator style businesses. Okay, so what is the difference? What is the difference between what Opendoor is pretending to do versus what Zillow and Co did and failed?
So what they're doing right now is not so different. And at one point, Opendoor was operating cash flow positive. There are two big threats to iBuying. And iBuying isn't the whole business. So at some point, they're going to expand this platform so people can list their own houses on their platform. And right now, they've already made it so that, for example, instead of selling your house to Opendoor, this kind of like a partnership project. Suppose you've been in the house for 15 years and you've paid off half your mortgage, and you only need half the cash up front. You can do some risk sharing, and so they'll list the house for you, and then they'll give you the second half of the money afterwards, not knowing exactly how much it's going to sell for. So there are some hybrid business models, but the core business model, which is you sell your house to Opendoor. Opendoor does some very light repairs. They have a lot of data on what things to paint and what things not to paint to get the most value out of the house. And then Opendoor resells it. That business model has two huge problems. One is the amount of time the house is held in inventory. It's costing you like $200 or $300 a day in interest expense and property taxes and insurance every day the house is in inventory. And the other problem is adverse selection. This idea that if it's old finance paper called the lemon problem by George Akerlof, where why is the car market so full of lemons? And it's because if people have a good car, they keep it, and if they got a trashy car, they sell it. The seller knows more than you. The seller knows if the transmission leaks or all these things. So if they bring it to the market, there might be something bad with it. And both of these problems, how long the house is in inventory, and this information asymmetry that the seller knows more than the buyer, AI is helping with both of those. So one of the information asymmetries is just computers were not good at calculating curb appeal if the house was pretty. Well, AI can do that now. It can scan millions of images and figure out if the house is pretty or not. One was awkward layouts. And a couple years ago, the idea was we could use LiDAR drones to map out the interior of the house. Now, if you just walk through your house with a video camera on, AI will make a floor plan and figure out if the floor plan is convenient or awkward. So there's a lot of information asymmetries that AI is solving. And then the big one is that number of days held in inventory. 30 days was the mortgage origination process. The mortgage origination process was just it's archaic. It's human beings with pieces of paper. It's a really ancient process in the US. It can be updated. And there's another company, so there's another totally AI native mortgage originator that I've also written about and I also own shares of. It's called Beeline Holdings, a little tiny micro cap, but they have a chat bot that will do mortgage origination, and it's 6 times better than a person, right? The chat bot does not get bored and hang up on you on the phone if you don't upload all your documents the right way. It's just infinitely patient as you try and upload your documents over and over and over again. So Beeline Holdings has a AI native mortgage originating chatbot, and Opendoor is rolling one out. It's in beta testing right now in the Colorado market, but because Beeline is already doing it, we get some glimpse at the numbers. If you get a 6% mortgage,
Mhm.
as much as 80 basis points of that rate is the mortgage overhead and gross profit. So you can buy points in the US to bring the interest rate down. That's another way of saying that the mortgage originator has costs. They have to keep the lights on, they have to pay the bills. So if you make this more efficient, there's about $12,000 per house per mortgage of labor costs in originating a mortgage. So if AI does it for a marginal cost is zero, you save about it's almost like 0.4% on the mortgage rate of the house. So these AI native mortgage originators, they're able to bring rates down just by taking the cost structure out of it, just by taking all that labor costs out.
And then how do they make money? Is it through like a trailing commission, or they're going to be the in-house like finance from go to woe?
So Beeline just repackages the mortgages and sells them immediately. I think within 7 days, and with insurance to cover the gap on the 7 days. I don't know the details yet of how open. I assume they're going to package them and sell them. I don't think they want to sit on a huge pile of mortgage. And then it's also a question of who's going to service the mortgages. They also cover rocket companies, and they do service their own mortgage portfolio. But what's interesting about imagine the house has about $25,000 of mortgage origination costs. Half of that is labor cost, and half of it's gross profit to the mortgage originator, mortgage, title, maybe an insurance, but about $25,000 worth of origination costs in there. Half of that can go away because AI replaces labor, and you can still have, $12,000 of gross profit. It's even more extreme in Opendoor because they were paying $200 a day, $300 a day to keep it in inventory, and they can take a month off of the holding period. So they're saving $1,000 by getting the mortgage underwritten in 3 days instead of 30. So not only can you take out $12,000 of labor costs, but now Opendoor can add $5,000 to their gross profit on every home. So, or their net profit if they take costs out. Opendoor launched a product. Right now, the 30-year mortgage is 6% in most of the country. Opendoor launched a 4.99% 30-year mortgage with no point buy downs, anything. Just if you buy it through Opendoor and you're creditworthy, then that would be the equivalent of spending that much money to buy down the mortgage, which you can do with a all the home builders do that. All the home builders take $25,000 of their margins and they will buy down your mortgage too. So there's this big disconnect between if you buy a new build home, you get a 5% mortgage, and if you buy an existing home, you get a 6% mortgage. And Opendoor is working on bridging that gap and bringing those numbers together. So it's pretty exciting because if you're a percentage point lower on mortgages than everywhere else, now if you're a seller and you have the ability to list your home on Opendoor because the buyers get a percentage less on the mortgage, and the ability for them to take this whole market fast and just to really scale up and take the whole thing is pretty incredible.
Okay, so let me see if I can summarize. The sellers are attracted to this new technology and the platform for the network effect of having buyers being attracted to the platform. Buyers are attracted to the platform because they can get an easier time getting the financing to buy. For the same reason, the seller starts to think that Opendoor's platform is more attractive because it's going to sell their house quicker. But they're still selling it technically to Opendoor first, and then they're reselling the home to the buyer.
Yeah, right now that's the business model, but
That's
they're moving pretty quick, and they've already talked about at some point there will also be the option just to sell your house on their platform.
Yeah. So
And
they
then
can
at
turn
some point,
themselves into a real estate exchange
yeah,
quasi.
they want to just sit on top of the entire housing market and then collect those transaction fees, just like being, instead of the New York Stock Exchange, it'll be like the housing market exchange. So it's that
Now you're
covers your.
speaking my language, mate.
Yeah, so that's your exchange business model, except housing is $130 trillion and the stock market's only 55 trillion. So now who's sitting on the bigger exchange
I like it.
if they succeed? And right now it's only a 5 billion market cap company, which is pretty shockingly small for the potential there.
Okay, so let's talk about the potential of this huge total addressable market. How much do you think Opendoor can capture, and by when? What would that lead us to reasonably and conservatively assume target price wise? What would that company be worth if it could capture a certain percentage of such a large TAM?
Yeah, I think just on a flip to net income profitability, because there's a lot of people just saying that, oh, the business model can't work and it can never work. And what's interesting about that is we got a new management team in September. So the first cohort under the new management team, so they hadn't even rolled out all the new products yet. The first cohort, which is the October cohort, already had, I think, 20,000 of gross profit per house. It was a 10% gross profit, which is pretty big because it's there's not a lot of profit margin, a lot of revenue, but not a lot of profit margin in the housing market. So that was already their most profitable cohort ever, and it was the first month after this new management team came in and started rewriting software. And the new CEO, he's the former head of product development at Shopify. And his 5 years at Shopify kind of turned that company from sort of, just starting out to being a giant cash cow. So it's got a high caliber management team, a pretty sophisticated group. I would put just very rough price targets. The flip to net income profitability, I'd put $20 a share. So maybe by the end of 2026, $20 a share. And then as they start scaling up, maybe by the end of 2027, something like $80 a share. And then by the end of 2028, I think, 300 to 500 is very possible if they're doing things right and if we're not raising interest rates yet and the housing market's really booming. So,
We'll get to that.
software can scale up.
Yeah,
Go ahead.
it's true. My only comments were that's monkey metrics on share price target. Talk to me about revenue, net income, and then a multiple to give me the enterprise value or the market cap behind those per share metrics.
Yeah. So if you figure you have the average house is about 400,000 and their gross profit is 10%, so they're clearing about 40,000 per house.
That's pretty
And
good.
what that comes from is in the US right now, the gap. So you've got real estate brokers taking about 6%, maybe 5.5% of that transaction between the seller's agent and the buyer's agent. Globally, that number is closer to 2%. So the United States, the real estate brokers have gone completely crazy with their monopoly. So you've got about a $65,000 wedge where if you sell a $400,000 house, the seller receives about $365 and the buyer pays about $425 with all the closing costs. So your mortgage origination, your title transfer, you've got some commissions for your insurance products. You've got your escrow origination. You've got all these different fees in there, but the big one is mortgage, a little bit more for title, and the real estate broker's commission. And so when you get all that out, there's already 65 grand to work with there, of which probably 40,000 can come out of that, and 20,000 is probably unavoidable. And then you also have the repairs, the fixing up. So the smart what to paint and what not to paint to add value to the house. And you just have the mismatch between sellers that are in a hurry and buyers that want to take their time. So right now, they can probably get gross margin of like 10%, make $40,000 per home. And I think the number of homes that turn over every year is something like 4 million. So if you I just calculated on a 10% market share. 10% market share, you're transacting 400,000 homes. You're grossing 40,000, you're netting 20,000. So whatever $20,000 times 400,000 homes is, it would be your net income with 10% market share. So 40,000 times 20,000 is how many zeros is that? 1, 2, 3. That would be $8 billion of net income with 10% market share of the housing market. And this has the potential to go to 90% market share because, again, it's a potentially winner take all feedback loop
The only
market.
right. Okay. Yeah,
So
I'm reminded of a few things. Uncle Rick always says that even he, a 70-year-old, can win the 100-yard dash if he's the only one that shows up. So that seems like we've got the first mover disadvantage is out of the way thanks to Zillow and some of the others, pioneers. May they rest in peace. The idea that this could become a fee collector on the real estate market is attractive to me. I'm less attracted to the hands-on aspect of the fixing up and the holding of the inventory, and makes it's not a bad. I know it increases their profits, but their margins, but it adds an extra complexity. And I'm a pretty simple kind of cat. So, what's the bear case? Where are the potential landmines, so to speak, for this business?
most of the landmines, the big one was adverse selection, that the seller knows more than the buyer, and then you end up with too many lemons in your fruit basket. So that's the big one. The other one is the cost of capital. Just as interest rates are higher, your holding cost of these houses. That's why the CEO of Redfin says that the business model is broken. Everybody likes to quote the CEO of Redfin who said the business model is just can't even possibly work. Which, if you think that 10 years from now, when you buy and sell a house, you have to go to a title agent's office and sign 10 pages of physical paperwork, I think that's kind of a silly thing because the whole world's gone digital these days. Those are the two real threats: is the amount of time that you have to hold the property to sell it, and then the adverse selection. And there's also, if there's a big crash in housing prices, well, you have this huge inventory. But again, that's also mitigated by just you got to turn over the houses faster. And so that's really the thing is just how to price it so that the houses turn over faster, how to take 30 days out of it by getting the mortgage origination down. It's just really about getting that fast turnover. So I mean, they could fail, but all the initial evidence, the October cohort is the only cohort we have because they started in September. They just announced earnings. The only cohort that they've actually worked through enough inventory to see things on was October, and it looks really good. They were able to get their 10% gross margin. And this is just after, after the new guys were only in there for a few weeks and they fixed up some of the software and changed the business model.
Sure. Okay. The only, yeah, again, the fragility from what I'm hearing is that amount of time, short as it may be, where they have to technically, they own the inventory and in a nasty downturn, which is probably less likely in the US, to be honest, for certain idiosyncratic factors, then you can get caught holding inventory that you can't move so quickly because you're going to take a big mark to market write down. Is that a fair summary?
Yeah. And one of the other new products they've rolled out, which is, giving the home seller half now and then some variable amount depending on how much the house sells for, also mitigates that because then, if the house falls in value 10% while you're selling it, it doesn't come out of Opendoor, it comes out of the home seller. So again, they're already rolling out new products to try and mitigate these problems. The people in charge of it are pretty sharp. I've been very impressed with the CEO and the chairman of the board. They are aware of all the right problems, and they're very aware of the reinforcing feedback loop in the market. It's kind of a rare thing because I think a lot of the sharpest minds in tech, they work in private companies and they only go public when they exit. So the public markets don't get a lot of experience. This company is 15% owned by Masayoshi Son at SoftBank. This is a Silicon Valley venture capital tech startup sort of deal. And you don't get a lot of those when they're still small in the public markets because they stay private until they're ready to exit. So, then you're the bag holder giving them exit liquidity. And because of the SPAC and because of the rising interest rates and because of them almost going bankrupt, I think you have this pretty rare opportunity to get grade A Silicon Valley talent working for you in a small cap, which is very rare.
It's certainly the upside certainly appears asymmetric. So we'll be keeping an eye on this one. The real estate market cap, so to speak, in the US, what did you say that's worth roughly?
I think the estimate I've heard is 130 trillion. I think that's single family residences. I think if you take in all the condos and stuff
Really?
like that, it's closer to like 200 trillion. And you've got,
Okay.
I think the amount that changes hands every year is 2.5 trillion, whether it's a big year or a small year.
Volume turnover. So yeah, that's certainly very interesting market cap. Here's an left field question. Would this kind of fit in with the silver tsunami thesis, given that maybe someone who doesn't want a reverse mortgage, it just wants to sell their house? Are we going to get some of that wealth capture from the boomers who own a lot of these assets, looking to potentially sell their homes?
So if you can bring the transaction costs low enough, I mean, if you're when you lose 6% of the house to real estate brokers, it's very painful. And then on top of that, it's a cumbersome process. By the time you lose 25,000 to the mortgage originator and 6% to the real estate brokers, I think if transaction costs were lower, the volume, the amount of people that would change homes more casually. Right now, if you're not going to live in the house for more than 5 years, you really shouldn't buy a house. And if that number comes down to like, oh well, you can chance it, see if you're going to have that job for 2 years because the cost of the transaction is so small, you can just take a chance on it. And then what really would really kind of piss off the millennials and the Gen Z cohort is when the liquidity of something improves, the asset price typically goes up. So if you take structurally the costs out of real estate brokers and mortgage origination, and the cost of transacting a house gets cut by 2/3, house prices might rise because of it, as people will, they'll move houses, they'll move into a more expensive house, and house prices could go up because of that. So, that's unfortunate if you're one of those, screw the boomers, they wreck the country sort of people.
Yeah. Okay. So this model probably will be perfect for Australia then, if it's going to advantage the booming demographic. No, just kidding. You want to steer clear of the real estate market here, personally. Okay, interesting. I was going to leave macro a little later, but because so much of that will tie in directly to Opendoor, given it's got interest rates and demographic sensibilities. What happens in a rising rate environment for a company like Opendoor Technology?
So yeah, they lost $1 billion in 2022 when interest rates rose, and it was because you had the sudden decrease in home prices, and they had a big slow inventory. When you get inventory moving faster, and maybe they get the majority of transactions onto that, risk sharing model where they only pay you as much as how much of your mortgage you have remaining. You kind of choose a sliding scale. Do you want all cash now and it's less, or you want to do a little risk sharing and probably get more? So if you've got, I mean, the housing market doesn't fall 20% of the time. If you just had 20% risk sharing onto the homeowner, then Opendoor would be pretty much totally insulated from a housing market crash. A housing market crash is when house prices fall 5% and people think it's the end of the world. Um, yeah, I think the people in charge of it are smart. They're thinking about these things and they're working on it. So now as far as what I think the probability is of a rising interest rate environment, we haven't even had Trump put in his new Fed chair yet, and Fed chairs have 6-year terms. So you figure whoever Trump picks, he's going to pick someone that believes in rate cuts, and then on top of it, we're going to have this tailwind of the artificial intelligence revolution and the disinflation that it'll give to services. So even while we have this commodity super cycle, while all the metals are doubling in price, if you have so much cost come out of services, then they could arguably with CPI say, well, inflation's not a problem. Inflation. So as far as when the next rate hiking cycle is going to be, you could be talking about 2030, 2032. When by that time, I think there's a good long way before the next rate hiking cycle. That would be my guess. I think you'd be pretty far out in left field if you think they're going to start raising rates now, because we haven't had an auto cycle. We haven't had a housing cycle. The housing market's been totally frozen and depressed. All the volumes of transactions are at record lows. If people look at that and they say we need higher interest rates, I think they're really seriously in trouble.
Okay, interesting. Are you suggesting that the Fed is influenced by the White House, Stephen?
So Arthur Burns, who was the guy before Paul Volcker, he was asked in an interview as he was leaving. He said he was asked about Fed independence, and he said, "Well, I had to do whatever Congress wanted me to do, or else they'd take my independence away. So if they can take your independence away, you're not independent." So I mean, the Fed independence has always been that's kind of a joke. Yeah, but also I think I do think there's a commodity super cycle. I think we've underinvested in commodities. I think all the commodities are going to become more expensive. But how many commodities does the typical American consume? Our consumption basket is very service oriented, but if you go to the third world where people are getting their first refrigerator and their first washing machine and stuff like that, then there's very commodity heavy. So you might have higher inflation in other countries, but the US people are very much service oriented in their consumption. And then the AI revolution, if it increases productivity and brings down costs, which it hasn't it hasn't done very much of yet, but the promise is right around the corner, then I think you might have this sort of tailwind for low US, CPI, however it's calculated.
Yeah, speaking of the third world and commodity consumptions, when you go to the gas station or servo, as we call it here down under, it's a painful experience at the moment. The petrol prices and diesel prices are certainly on the rise. So your argument then, or your inkling, is that the service disinflation in white collar services will more than counteract the rise in raw commodities, because the discretionary income in the developed world and the United States is more geared towards services.
Yeah. And I think you might see something very different in a country where, your marginal dollar is going to buying your first electric scooter or buying your first moped or buying your first something made out of metal, your first washing machine, you don't have a bicycle powered clothes washer anymore. You want your first electric washing machine, that sort of
Commodity and
stuff.
goods, for
Yeah.
sure. For sure. Interesting times ahead. We'll see. Achilles heel with rising energy prices, not going to put the bond market under pressure in the US. You
Yeah.
don't think, for all the reasons we mentioned?
Well, I mean, it all comes down to when the Strait of Hormuz opens again, and that's anybody's guess. Not to be like the permanent optimist and get accused of being a Pollyanna. I think it's going to happen relatively soonish. I don't imagine this. I don't think this is going to be like a 6-month lockdown. I mean, we'll have to see. Everything you're hearing from the U.S. is that they're kind of running out of targets to bomb in Iran. There's just not that much left. So how long can they? So the missile launchers, there's a very limited number of them, but the drones can be launched from the back of an 18-wheeler, so that's a little bit more decentralized. So they can be sending drones at oil tankers for a while until we get them to stop. But I think the U.S. is kind of pushing for people to take to the streets again and overthrow their oppressors, and we'll see if that. There's an interview recently with the son of the deposed Shah of Iran, might come back to lead a secular government, and he claims that he's had he set up this channel where people that work in the military can reach out and contact him discreetly, and he claims he's had 1,000 Iranian military members reach out to him ready to switch sides at any moment. I don't know why he's saying that, but so we'll see if there's some big storming of the Capitol and replacing of whoever's left in the government that hasn't been bombed yet. But
Yeah,
go ahead.
no, it was only what was running through my mind. Something Jim Rickards said to me a while ago was, look, no matter how bad something is, you can't beat something with nothing politically. So you need to have some other guy willing to step up and provide some change. So we'll see. And I don't know if you've listened much to what Dr. Anas Al-Haji has been saying, but it made some really good points about the fact that it's not so much Iran or not in their interests to close or block the strait. It's mainly an insurance issue where insurers are not willing to underwrite ships. So if anyone listening wants to go further down that rabbit hole, he would be an excellent guest to listen to.
There's a lot of misinformation going around out right now, but I had heard that the Lloyd's of London had reopened insuring, and that normally the price is something like 0.5%. What was that?
At what cost, though?
Well, yeah, but so the bear case that I heard, somebody who was very adamant that the Strait of Hormuz will stay shut because of insurance, that the insurance cost had gone from 0.5% of the value of the cargo to 3%, and that this would destroy shipping 3% of the cost of the cargo. And to me, that didn't sound like it would destroy the cost of getting through the Strait of Hormuz if the price of oil has gone from 60 to 90. You know what I mean? And again, there's a lot of misinformation going around right there. But my understanding was Lloyd's of London was insuring, and that it was 6 times what it used to be. But that didn't necessarily seem to be all that cost prohibitive to me. I think right now it's and there's other things going on. So the Greek Seafarers Union called a strike and said, we don't want our seafarers getting blown up. And then there's I think Maersk did something similar. So the sort of the first world countries don't want their high value employees getting killed, but there's also a bunch of ships manned by Filipino staff that probably don't care quite so much. So I don't know. I think we'll have to see at what point ships go through the Strait of Hormuz, and probably a few at a time. But one thing about Iran with the government is they already instituted this, what they call it, the Mosaic defense policy, where every unit is autonomous. They're all on their own because they're not going to get any more communications from the central command, because a big chunk of the central command is dead and the communications have been knocked out. Right? These are people that are on their own, whether or not they want to keep on launching some drones. And then what do they even launch them at? So a lot of the recent drone bombings have been going towards buildings and not towards ships. And I have to wonder if that's because they don't have, live intelligence for where the ships have moved to, but they have old satellite intelligence for where the buildings are. Because they launched an awful lot of drones at United Arab Emirates at like residential buildings and things like that. So it's a bizarre world. There's a lot of unknowns. There's a lot of misinformation. But I think you'll see some kind of change in the situation. I don't know if it's within days or within a week or two, but I don't think it's going to be a 6-month problem.
Yeah, you mentioned the drones in Dubai. It's a tough time if you're a fitness influencer in Dubai. Now, one thing fitness influencers have been peddling in the past are weight loss products, Stephen. And so we need to talk about LifeMD. Do you like that segue? LifeMD is a very interesting company. I know nothing about it, and yet I've profited it quite handsomely thanks to you, basically. So I outsourced my due diligence to you. disclaimer, I don't normally do that, guys, and I'm not recommending it. But let's talk about LifeMD. That was a case of buy now and research later. Let's do some research together now that I've got you on the phone, so to speak.
Yeah, so before artificial intelligence and before the Iran war, the big hot topic was Ozempic and how it was going to change the world. And it is making huge changes in the world. Some of the big early losers were companies like Weight Watchers, and there's another one similar to Weight Watchers that has their own food products, a sort of low-calorie meals called MetaFast. And you also have these online health platforms that, there's a lot of medication in the US you need a prescription to get. Some countries don't even have prescriptions. You just go to the pharmacy and you talk to the pharmacist and buy what you need. But in the US, the land of
Yeah.
freedom, you need permission to buy your drugs. But with telehealth platforms, you can get a prescription, over the phone. Now, these telehealth platforms for getting a prescription over the phone, it is a crummy business model. It's a CAC, customer acquisition cost business. It's not like Uber and it's not like Opendoor where it can has a self-reinforcing feedback loop and have a winner-take-all market. But the nice thing about that is you don't have to pick the market leader, because this market can survive with all sorts of contenders in it. So you don't have to worry, Hims is bigger than me, so I'm going to lose, because it's just a customer acquisition cost market. So LifeMD is a telehealth platform. It's, very similar to Hims and Hers, but their men one is called like RexMD for Kings. And they've got the men's health, the women's health. It's very similar to Hims and Hers. But the big difference was that why I thought they had an enormous advantage and why I thought that it would be a good idea is MetaFast, this competitor to Weight Watchers. It's kind of like if you combined Weight Watchers and Herbalife. It's a gig economy Weight Watchers where all your yoga instructors and your fitness coaches, as a side hustle, sell MetaFast services. So if you're at your gym and you hire your personal trainer and you're overweight, he might say, "Hey, do you want to hire me for a couple $100 to give you some personalized weight loss coaching?" And it comes, we'll ship you in the mail, 2 weeks worth of low calorie meals or something, and we'll get you to lose weight. So that was the MetaFast business model. You had these gig economy, this decentralized, I'm not going to call it multi-level marketing, but it's very gig economy oriented, like a Avon lady or a Herbalife. Now they had 40,000 of these people across the country doing these, signing people up for this, and then Ozempic came along, and he's like, "Hey, do you want to pay this fitness coach $300 to lose money, or you want to take the magic weight loss pill?" So they were in a crisis. They were like, "Oh crap, what do we do?" And their path to survival is they bought an equity stake in, they invested in LifeMD, this telehealth platform. And now when your fitness coach signs you up for this package to send some food in the mail and to have some personalized training lessons, it also comes with your registration at LifeMD and your pharmacist to prescribe you your Ozempic. So it's a one package deal. So now LifeMD, who's in this customer acquisition cost business, suddenly has 40,000 gig economy workers selling their product at no cost to LifeMD. So your customer acquisition cost is zero, and you've got these 40,000 gig economy workers out there hustling. But it wasn't work. So this has been wrong for a while, and it was wrong for a while because Ozempic was $1,000 a month. And when your target Ozempic customer is a millennial woman, a professional woman, we call her 35 to 45, millennial woman, and it's worth $1,000 for her to be thin. Otherwise, she can't get Chad on the dating apps. But that's all of her discretionary income. She's got nothing left. And then what happened after that was you had this bootleg compounder situation where, you didn't have, it wasn't a generic drug, it was still under patent. But if you blend it with another drug, it becomes a new drug. And so they were being competed against by companies that were launching compound drugs to get around the intellectual property and undercutting the price. You could pay $1,000 for Ozempic or pay $250 for Hims and Hers compound drug.
Right.
D never did the compound drugs. They only did the partnered branded Wegovy, which means they lost market share. Nobody wanted to go through them and pay $800 for the real thing when you can pay $300 for the bootleg thing. Now, two things have happened. The FDA has cracked down on 30 telehealth platforms that were selling compounders illegally or legally questionably. And the branded stuff, for one, there's an oral version instead of an injected version, which about half of all potential customers just don't like needles and stay away from it. And they brought the cost way down. So now even the branded version is like a couple $100 instead of 1,000. So now we know more about Ozempic, and we know one of the big problems is muscle loss. You really do need a fitness coach with you in the gym teaching you how to lift weights and preserve your muscle mass while you're on Ozempic. So now people know you actually do have to worry about the muscle loss. And then there's the discretionary income. Instead of spending $1,000, you're spending 200, $300 a month. Well, now you have $300 or $400 to pay your Medifast coach. So I think companies like Medifast are back in business, and they did just have their first quarter of growth. But the devastation, the year when everybody was using compounders, Medifast went from 40,000 gig economy workers down to 16,000. Right, so that's how many people quit their side hustle in Medifast. They lost 24,000 yoga instructors and fitness coaches because who needed it? You've got Ozempic. But again, now when it's not $1,000 a month for Ozempic, when it's 200 or 300, all these millennial women have like $700 a month discretionary income extra to spend it on. They're not going out to restaurants, right? They're not spending it on food. So what are they going to spend it on? I think Medifast has a real shot now to retake market share. And then the other place that I would be is apparel. So these millennial women that just got $700 extra a month, I think they're going to American Eagle, they're going to Abercrombie and Fitch, which have both just announced, return to growth, record earnings, that sort of stuff. So that's what I would do. Is I like left. They struggled for a long time, but they struggled because of the compounders taking market share. Now the name brand is on top again. It's cheap, and they have 16,000 gig economy workers selling their product with zero customer acquisition cost, and I think it's in a really good position. So that's what I'm doing is LifeMD and American Eagle. And if you want to play it risky, you could buy some Medifast, you could buy Abercrombie and Fitch. Those are the two that I like, is LifeMD and American Eagle.
Yeah. So once again, millennial women win, basically. And they always win. They're like the house. They always win. So American Eagle, LifeMD, cat food companies probably looking to do well in this increase
Well,
of purchasing.
they might not have cats anymore, because if they lose 80 pounds and they suddenly are attractive on the dating apps, they might actually have a real boyfriend instead of a surrogate. Instead of having 3 cats, they might actually be out in the clubs. So we will see.
Cat lives matter, Stephen. You know that. So that's very interesting. LifeMed looks like, based off the price action, that it's turning around. It's still on enterprise value of 160 mil. So it's a pretty small. The company valuation is fairly low, and yet it does have some free cash flow expected to come in. What kind of multiple can this thing achieve? Let's say 2026. Let's go to 2027. What kind of net income do you think this thing can do, and what will the market value that net income at?
And the company is so small, and the growth, again, it depends if this it depends if the market really recovers. And the last earnings call for Medifast was pretty encouraging. But again, you're just predicting, what are these millennial women going to do with their $700 a month? And also there's the senior citizen cohort too, and they're much more concerned about muscle loss. The senior citizens might actually get their personal trainer at the gym, because muscle loss, when you're in your 70s, suddenly you fall and break a hip and you're dead. So they're the ones much more concerned about the muscle loss. So as far as management's guiding for kind of a low growth rate, but it's a zero marginal cost business because it's software. So it all depends on what those 16,000 gig economy workers are going to do, and it could surprise to the upside. The company's debt free, and they've got $38 million in cash to spend on maybe some more advertising, customer acquisition costs. Um, a, a, a high gross margin growing business could trade between 3 and 5 times price to sales. And right now it's 0.8 times price to sales. This is easily 3, 4, 5 bagger just when the market believes their story. The market will probably wake up to their story with return to growth. They had owned, so early on in their development, they invested $500,000 in a small SaaS startup. And then they sold it back to the founder for something like $30 million. So they 60 times their money, but that's messing up the trailing revenue. So if you look at trailing revenue, it looks like there's this big fall off, but because they sold their SaaS startup that they had acquired. So once the data confusion rolls off, it might take 2, 3, 4 quarters before that effect of selling that SaaS company falls off and people realize, okay, it has returned to growth, it is profitable, it has no debt. Yeah, I could see it return to 3, 4, 5 times price to sales. I could see it be a 3, 4, 5 bagger pretty easily.
My only remaining question is just wanting to delve in a little bit more on the revenue mix. So, does this have what I would call in inverted commas, a real business in the sense of something to do with medical? Like it's called LifeMD. How much connection between patient or end consumer and not so much the fitness weight loss side of things, although that's certainly important. We've covered those. What else can be essentially sold through this connection pathway?
There's a lot of there's a lot of leisure pharmaceuticals in the US, and that's kind of what the telehealth platforms are doing. Is you got your erectile dysfunction medication. I'm sure you know all about that. And you've got your hair loss medication, and you've got your hormone treatments for menopause and things like that. So there's women's health and men's health.
Okay.
Testosterone replacement therapy. There's a lot of 60-year-olds suddenly want to become jacked and have testosterone supplements, things like that. So a lot of this is very leisure oriented, but they are trying to get into things like diabetes care. So the best customers are the ones that need you all the time. For example, diabetes patients, type 1 diabetes patients, they go and get blood tests regularly. Well, it's very inconvenient to go to a doctor's office to prescribe the blood test when you can do that on your phone. But all the telehealth companies are all compete. Like every telehealth company is fighting over who gets the diabetes patients. So right now, Teladoc has, I think, 1.1 million chronic disease patients that just keep on coming back for these routine calls, and that's what everybody wants. LifeMD wants to acquire those. Teladoc is, a large player in the market. But again, it's not a winner take all market. It's customer acquisition cost market. So there is a real business there, right? They could be servicing type 1 diabetes patients. They have that platform. They can be doing, estrogen replacement for menopause and testosterone for, 60-year-old men. A lot of it is these sort of leisure pharmaceuticals, the, hair loss, erectile dysfunction, testosterone replacement, that sort of stuff. But a lot of it is actually genuinely necessary medical, getting your blood tests and things like that. So um, there is a real business there.
Okay. Yep. Certainly sounds like it. And they can capture some of that market share. It's good that we're talking about fitness and personal training in the gym. Hopefully, you've been doing your stretches because it's time for you to do your victory lap, mate. So, hopefully, you've warmed up well so that you're not going to pull a hammy on your victory lap. Abacus Global now, is that to global management? That's what this is a life settlement company turned acquisition behemoth in the making. Talk me through the latest on Abacus Life. We've spoken about it many times in the past, and it seems as now that the market has woken up and the company is twice as expensive as it used to be, people are all of a sudden more interested in it. It's funny how that works.
Yeah, I did get a lot of hits on my write up this morning for their earnings call. But what's amazing is the market reaction to this earnings call was down, and I was very surprised by that. So in the US, because of a Supreme Court case, life insurance policies are personal property and you can sell them. So if you're 15 years from the finish line, if you're 70 years old and your life expectancy is to 85, somebody will buy your life insurance policy. That is still relatively unknown. There's still about, between 75 and 85% of life insurance policies that have real value lapse because people just stop paying the premium. People get life insurance to say, if I die, I want my wife taken care of, the house paid off, and the kids going to college. But then you become 65 years old and your house is paid off and your kids have graduated college. And you say,
And you
why
don't
am I
like your
sending
wife
a
that much anymore.
yeah, maybe. When I was a financial advisor, I had some people like that, some newly retired people. We've been married for 35 years. I love my husband, but now that he's home every day, I can't stand him. Get him out of the house. Do something. Well, have you considered golf? Have you considered bridge? What can we do to get your husband out of the house? But there's
Testosterone therapy at LifeMed.
Yeah, send him to the gym, get him this new fitness trainer. Oh, my tiny hometown in Maine had a scandal in the local newspaper that there's this dance athletics, what is it, Zumba or something like that. Anyway, they had this very attractive woman come from Colombia doing this fitness class, this Zumba dance class, and it turned out that it was also
Ridiculous.
prostitution. And she got the mayor, the police chief, the whole town. This tiny town was all taking Colombian dance exercise, and she was also a prostitute. And anyway, huge scandal. So maybe don't send your husband choose your fitness trainer carefully when you send your husband out for his testosterone replacement therapy and weightlifting.
Yeah, next product on the distribution list for LifeMD will be scopolamine. Scopa's real. Be careful, boys.
So yeah, what were we talking about before I segued to?
Something to do with people retiring and they're sick
Yes.
of.
So the life insurance policy, you sell your life insurance policy, you get to retirement age. Most people just stop paying the premium, and their life insurance policy had value, and they could have sold it. And this market is still so underpenetrated, right? There's, in face value, $450 billion. So life insurance policies in the US is a $14 trillion asset class, which is bigger than the stock markets of Germany and Japan. This is a big asset class because the United States is a huge country. There's a lot of life insurance policies. 450 billion a year of face value of policies lapse. People just stop paying the payments on them. And about $150 billion a year, the people were old enough they could have sold it and they didn't know it. And so Abacus will buy that life insurance policy. They pay roughly, I think on average, it depends on your age, but the average payout is something like 20% of face value. So if you have $1 million life insurance policy and you just turned 70, there's a couple $100,000 they're willing to pay you for that life insurance policy. Now they turn around and they sell that to private credit for a 20% markup, because when you sell it to private credit, you go to private credit and say, hey, here's an 11% yield uncorrelated to the market. And the payment comes from a regulated, A-rated creditworthy life insurance company, which is regulated to have a certain cash reserve. So now you have an extremely creditworthy, high yield, uncorrelated investment. And private credit loves this stuff. So they can buy a bunch of them. So the real challenge is origination. The real challenge is, how do you go on Facebook Marketplace and advertise to baby boomers? How do you get, on the television screen at their fitness club? How do you get the word out that your life insurance policy is worth $200,000, and don't just stop making the payments, sell it to us?
Yeah, for God's sake.
And so they've been cracking into the advertising to grow, and their growth rate has been absolutely incredible. In 2022, so I just wrote up this quarter, they went from $35 million in 2022 originated, or capital deployed, how much they spent buying policy. And then they went to $65 million in 2023. And then they went to $120 million in 2024. And quarter four 2025, they were able to deploy $230 million. So this company has almost doubled its volumes every year for 4 years. It's this incredible growth rate because the market's so underpenetrated. They just have to reach people. They just have to get the story out. And they're far and away now the market leader in their space. They used to be the number 2 player, but I think they passed by the number 2 player maybe about a year and a half ago. So now they're the market leader in the space. They've been around 20 years. They buy these life insurance policies and resell them. And the market does not believe the story yet. It's almost doubling every year, and the market doesn't believe the story. One of the reasons is they keep on making these acquisitions. The market does not like acquisitive companies. They say, oh, are you empire building? Are you planting flags? What are you doing with all this shareholder capital? And I think the acquisitions have been very smart. So I'm kind of alone as an army of one, cheerleading the CEO, that I think these acquisitions are very smart. One of the first things they bought was a mutual fund company. And they said, well, instead of private credit getting 11% uncorrelated, if we sell it to our mutual fund, if we have this mutual fund for these life settlements, then retail investors on a gated mutual fund could get 11% uncorrelated. And then for controlling the mutual fund, we can have 1% assets under management recurring. So we sell it and keep it. So now every time that they originate, $100 million of life settlements and they put it in their mutual fund for retail investors, their net income goes up by another $1 million a year because they get their 1% assets under management fee. And then there's the naysayers, the bear case is, oh, but this is related party transactions and blah, 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 blah. This is not trustworthy. And the response to that is, okay, if you're a mutual fund, now you're dealing with the SEC. Now you have the Securities and Exchange Commission breathing down your neck. Life settlements is already regulated, highly regulated by the life insurance companies. You have to satisfy life insurance regulators. You have to satisfy the Securities and Exchange Commission. And part of the life insurance regulators is Abacus Life has to rely on third-party valuations. There's 6 life estimate companies. So Abacus Life isn't even the ones saying how much these policies are worth. All the valuations are done by 6 external third parties. So if you're going to, say, oh, but these are related party transactions and who knows what, they could be cooking the books, they could be fudging the numbers. No, there's too many regulators, too many layers of regulation. You to satisfy the SEC, the life insurance regulators, and you're using third-party auditor, the third-party life estimators pricing. I don't take that bear case very seriously. I think it was very smart to buy a mutual fund company and then you get to sell it and keep it at the same time.
Yeah, vertical integration, I think in the long term could really pay off for this type of.
Yeah. And this last earnings call, which I think should have made the stock price double because they doubled volumes over last year, they announced another acquisition. They bought an equity stake in a financial advising company. And the thought process here is, okay, you give a 70-year-old a check for $300,000. What if you could say, hey, you just got a check for $300,000. How would you like to talk with our affiliate financial advisor who's going to help you spend that on a nice, S&P 500 ETF that we also produce so that we can get 0.25% assets under management fee from that?
Or fitness lessons in Maine.
Yeah, or Colombian fitness lessons in Maine. So you give a 70-year-old guy $300,000, and we joke
And
about this, but
LifeMD will become the necessary hookup there. Anyway, look, there's room for all the above, really, I think.
no, but you read some news articles about this in Florida because some of the senior communities have some really serious scandals. So I'll save you the gory details, but there's definitely some. Once everybody's through menopause, there's no risk of getting pregnant. And now that Viagra's been around, you see some raunchy stuff in the newspaper in Florida. But yeah,
Was
if you're going
Florida.
to give a 70-year-old $300,000, maybe also say, right this way here, sir. Why don't you come to our related financial advisor, and we'll help you spend the money. The market did not like this acquisition. And the CEO of Abacus, he believes that within 5 years, 30% of the company's revenue is going to come from this segment. That giving somebody a check for $300,000 and then helping them spend the money could be almost a third of the business. So that's his, he spent $58 million acquiring an equity stake in a financial advisory company.
What? How much are we talking? How much of the equity stake are we talking about?
They didn't disclose, but I think that whole company sold a few years ago for $280 million. So maybe it's 20%, something like that.
And enough to have some influence for sure.
Yeah. What I think people are missing about this is, so Abacus spends money on advertising to tell old people about their products, but they have 2 sales channels. One is through direct advertising, and the other is through financial advisors, teaching financial advisors, hey, this thing exists, you can help your clients do it. Once you have an equity stake in a financial advisory company, that becomes a new sales channel. You can teach all their advisors about it, and they can tell all their clients about it. So out of this company's client pool, it's not going to take very many originations for that to pay for itself very quickly, because the cross selling there, and they also still own the chunk of the company afterwards. They haven't lost anything.
And are they allowed, or are they able to, let's say, incentivize the advisors to push the products that they own a little more, or is that frowned upon?
I don't think that there's a commission on the life settlements. The big incentive for the advisors, and when I was a financial advisor, I would be all about it, is your customer now has $300,000 of cash to spend. And so that's, as you know, you either get your upfront commission as 3 or 5%, helping them spend that cash in something with a front-loaded fee, or you get 0.5% over time as you invest that into something with an ongoing recurring fee. But yeah, for me, the big draw as a financial advisor is you get to help them spend the money. If you tell your client, hey, oh, I could get you, one kid is a doctor, the other is a lawyer. They don't need your inheritance. How would you like $300,000 now? And then you can go on some cruises for Norwegian Cruise Lines, and we can increase your income. We can put you in Franklin Templeton's income fund, and you can get a monthly check in the mail. I think that's a very easy sell for financial advisors. So yeah, I don't think there's a commission that way, but I think it's just, teaching the financial advisors about it and getting them comfortable with it, and then having them do that. And then there's another tailwind, which is recently the estate tax in the US was reformed. So it used to be one of the ways to get around estate tax was to buy a jumbo life insurance policy. So if you suppose you owned a business that was worth $25 million and you didn't want to get taxed on it when you die, you could buy a $10 million life insurance policy, have the beneficiaries of the life insurance policy be your kids. When you die, they would receive that tax free. So you pay the premiums for the life insurance policy from the cash flow of your business now, and then that chunk of money your kids receive without an inheritance tax. But in the last budget, Trump reformed the estate tax. So it's, I think, 26 million, it might be 26 million each for the husband and wife, but there's now a huge threshold for that you have to overcome before you get taxed with your estate tax. So now people are selling their $10 million life insurance policy. So for the first time, they're getting these jumbo policies come in. So yeah, maybe I don't want to spend $10,000 a month on this life insurance policy. Maybe I'd just like to have a couple $1,000,000 cash now. So they're getting these big jumbo life insurance policies for the first time. So there's some good chances that origination can keep accelerating here. There's a lot of things working in their favor. And those jumbo life insurance policies, those are people with financial advisors that's going to hear about it as a recommendation from their financial advisor. So, and you can see in the competition, the number 2 life settlements company, their average life insurance size is a much smaller policy. So right now, Abacus Life's average life insurance policy for their customers is like $1.5 million. So they've been in the high end and the white glove, financial advisory firms and really working with the high end. There's a lot of room for this information to trickle its way all the way down to the Edward Joneses of the world.
Now, remind me of the size of the prize here. So what is the estimated total addressable market, and where are we at in terms of Abacus's penetration of that market? What does that translate in terms of revenue and net income, and what can the market reward it for via a multiple?
So you've got $14 trillion of life insurance. You've got about 450 billion lapsing every year. You've got 150 billion lapsing every year that they could have sold. So really, it's every year $150 billion worth of baseballs come across the plate for you to swing at. And this quarter, which they just doubled over last year, they deployed about $230 million of capital. That means they bought about $1 billion worth of policies. Out of that 150 billion opportunity, they might originate 4 billion face value of policies this year. And they're the largest participant in the marketplace. In 2024, all life origination companies combined did 5 billion face value in business out of 150.
Wow.
So this is a market that's 3% penetrated.
Hasn't even scratched the surface.
Just scratching the surface. Yeah, I mean, Abacus could 20 times their business just to penetrate the market. And it's just a matter of reaching all these people where they are, talking to their financial advisors and getting in front of their Facebook screens and getting them on the television and getting them to call the number. Yeah, the growth path here could be absolutely outrageous. And again, if they deployed $230 million capital this quarter, they're going to mark that up 20%, sell it to private credit. So they're going to make, call it $50 million of net income about 6 months from now when they sell these policies. They've got about a 6-month turnover time. So they turn over their inventory twice a year. So if they deployed $230 million of capital today, they're going to make about $50 million net income in Q2 next year. And this is a company that's, I think, still trading at less than $1 billion market cap. And I think they're on about a 200 million net income run rate right now. So that's a price earnings of 5, but with a growth rate that they just doubled in a year. They doubled every year for 4 years. I mean,
So
if they slowed down
If they're due to do 50 million in, let's say, first half, isn't that 100 million for the year, call it 2026, on a current
No,
market
50 million in quarter two.
in Q2? Okay. So annualized close to 200.
Yeah,
Okay, I
management's
see.
guiding for 100 million of net income, but management has beat their earnings guidance 11 times out of 11 times, which means they keep sandbagging. I think they're just sandbagging too aggressively, that they really should be a little bit more honest about what they're actually going to bring in. But I think their net income run rate's somewhere between 150 million and 200 million right now.
So we're talking a market cap to anticipated net income of around 5, possibly less.
Yeah. And I mean, there's more going on. So they just did their first securitization. So they took these life settlements, and instead of selling them to private credit, they layered them into tranches of an asset-backed security. And where private credit was buying it for an 11% return, the regional banks bought it for something around a 6.9% return. So what used to be a 20% markup, they're capable of generating an 80% markup. So if you deploy $100 million of life settlements, you turn around and sell it for $180 million, their profits have a potential to really ramp up here pretty high. And they just, as a proof of concept, last fall, they sold the first one. It was a $50 million face value security. But they guided toward, in the first half of this year, launching another one that's at least $100 million, possibly bigger. Right now, they have $400 million of book value of these life settlements on their book value. So that's their inventory that they're going to layer in tranche for sale. So they could easily do, $100 million face value, not face, $100 million cost to the regional banks, asset-backed security. But that would only have about, call it 55 million of the capital they deployed this quarter in it, right? So they deploy 230 million. So what I'm trying to say in a very roundabout way with the numbers is their profitability isn't 20% anymore. Their profitability, last quarter, it was 37%, or 32%. And then this quarter, I think it was 27. So they're expanding their margins by securitizing these life settlements and selling them to the regional banks. And the
Yeah, so
appetite there is,
transforming from an insurance arbitrage business essentially into a far more vertically integrated offer.
yeah. Yeah, they want to become, so very, very similar to Opendoor, they want to become a market maker and sit on top of this whole industry. And that also goes to, um, they said they've been in business 20 years. About 10 years ago, private credit got interested in this stuff. But the thing is, private credit funds, a lot of them have to close down after 10 years. So there are private credit funds that bought life settlements 10 years ago for people that 10 years ago were 70 years old. Well, now they have about a third remaining of people that are now 80 years old. And so they have to sell them back because that fund has to wind down. That private credit fund has to close after 10 years. So now there's an opportunity, and they just hired 2 executives to be in charge of this, of acquiring these assets, of going out to the private credit funds, especially while they're in a redemption crisis, maybe buying them on the cheap. So again, they're going to be a market maker sitting in the middle of this whole market, buying back now these policies from the private credit funds that have to unwind them, layering them in asset-backed securities and selling them to the regional banks. And the markups on these things are very nice. And there's no one else that can do that right now because their largest competitor is private, and you have to satisfy the SEC to be able to sell these asset-backed securities. So I think they've got a couple-year head start to be the only one doing this. And there's a lot of distress in private credit right now.
You can say that again. So let's talk private credit. I was restraining myself uncharacteristically. So you don't need SEC approval, so to speak, to buy these things because private credit acquired them and now they can't offload them. So that's interesting. Second, I've been listening, I like to listen to Jeffrey Gundlach, and he has, let's say, a distaste for private credit, given this, there's all this kerfuffle around not having to mark to market. So some of the accounting of these things is, let's say, imaginative in terms of what they say they have on their books in terms of a book value versus if they actually if they really needed liquidity, what they could really get when they sold, if they were to sell some of these assets, is like night and day. And some of this is literally between they're marking it at 100% and they should really be marking this down to zero. How much of a worry is it to you, this whole private credit bubble come or racket come bubble?
So I'm personally not too worried. I know that people are saying, oh, this is the next financial crisis. But if you look at the size of the market and the amount of leverage, so the housing market was an enormous asset class. It was the majority of banks' balance sheets. And the banks are intertwined with interbank lending. If you look at private credit, there are some that do syndicated deals, and there's also a lot of private credit institutions that only do their own originated deals, so that there's much less interconnectedness and there's a lot less lending to each other. And the amount of leverage in 2007, the banking system was 11 times levered. The typical private credit fund is 2 times levered. I mean, if you get a deal wiped out, it does sting a lot, right? It wipes out a lot of returns. But at 2 times levered, you can, you're talking about the big risk right now that people are worried about is software. And software is about 20% of loans from private credit. So if you're 2 times levered and 20% of your book gets wiped out and goes to zero, you're still alive. So the degree of leverage is much less. Another thing is, so not all companies are created equal. I did a deep dive. I found one BDC, a business development company I really like. But one of the problems is just if people are afraid, they'll ask for redemptions, they'll ask for their money back. But a lot of these funds are gated. What's interesting about a business development company, it's a lot like a REIT, so like a real estate investment trust. They have to pay 90% of their income out as dividends, but it's like a closed-end fund. If you sell your shares, it doesn't redeem any money from the company. So they can't have any capital calls. Nobody's coming to them asking for their money back because you can't, because it's just a publicly traded, like a closed-end fund. So they have a business development company has no risk of people saying, hey, I need my money back. And I found one that I like. It's called Trinity Capital. It has aggressive insider buying. It only has a 9% exposure to software. And that 9% exposure, that was 3% up until 2 years ago. So their 9% exposure to software is recent. It's 2 AI companies, and it's asset backed by the cloud or by the hardware, by the GPUs. So these are asset backed loans backed by the GPUs to AI companies. And NVIDIA says their GPUs are valuable at least 6 years out. So I really like Trinity Capital for that reason. Another thing is, okay, it's mark to market. So you say, oh, is this worth what I think it is? But you can gauge the health of these companies by what percentage of their loans are still paying cash. Because if they're paying you cash, the company's got to be at least a little okay. And they've also got payment in kind, PIK. So instead of paying cash, they start paying you in more shares of this debt, right? So instead of paying, if you have a $100,000 debt and you can't pay 10% interest, that just becomes $110,000 of debt. And then the next year you owe $11,000 in interest.
And then they take over.
Yeah, and eventually they take over the company, or they sell the company and they get made whole that way. But only 1.2% of Trinity Capital's companies are on PIK, payment in kind. There are some private credit funds that number is 4 or 8% or even higher have already moved to payment in kind. Again, you can dig through the private credit and find some, I think, interesting, well-run companies. They don't have the systemic risk of the banking system. You don't have this massive interbank lending problem. They don't have the leverage. 2 times levered is very, very reasonable. If all the fear is in software and it's 20% software, I mean, the typical bank is like 40 to 50% mortgages. So when the mortgages go bad, it's a much bigger problem when you're 11 times levered and you've got a systemic interbank lending, and it's 50% of your book is so.
They've got the Fed put, so they'll get bailed out. With the GPUs, that seems to be a bit of a risk to me. Every year, NVIDIA seems to come out with this new version of a chip that's just so much better than the previous version. I'm not sure if that makes amazing collateral, to be honest. So talk me through your thinking with regards to...
Yeah, I mean, I'm not saying it's a perfect. I'm not saying that the business development company is as good as your gold royalty company or land bridge. I'm just saying that, but the dividend yield right now is a lot higher. So if you like a 13% dividend yield for a company that seems to be conservatively managed and insiders are buying, then it does become very interesting. But there maybe about a year ago, there was Nvidia had a price drop, and it was because so you have competition. You've got Google's TPUs, you have AMD trying to make competition, and the idea is, oh well, Nvidia is so far ahead of them that these companies can't keep up. But then Jensen Huang comes out and says, oh, but our 6-year-old GPUs are still being 100% utilized and they still have value. Because he's trying to say that the depreciation on his GPUs aren't really that bad. Everybody's worried about depreciation. But the market took it a different way. The market said, well, maybe AMD is behind you right now, but AMD isn't behind your 6-year-old chips. So that means AMD has a market that they can attack. But anyway, the market kind of interpreted Jensen Huang less optimistically than he thought. But long story short, yes, a 6-year-old GPU still has some value. I mean, it's as far as debt goes, it's collateral. It's better than nothing. Oh, another metric on Trinity Capital. So the average loan to value for private credit is about 40%. Now you say they don't have their mark to market, so you don't have the marks or whatever.
Mm-hmm.
Most of them they're loans to growing companies, and these growing companies are still raising money, but they do equity rounds of fundraising. So there is a new mark when there's a new equity round of fundraising for this company. So if
Okay.
somebody comes in for a Series C and says that your company is worth $2 billion, that's a new mark. So with those new equity rounds of fundraising, Trinity Capital's loan to value is 17%, is extremely conservatively positioned in a world where the average is 40% and some companies are up to like 60% loan to value. Again, this is kind of like a way of getting exposed to venture capital, where these are small companies, the banks will not give them a loan. To give this company a loan, you have to be able to understand the business model. And then the other side is, well, it's asymmetric because the best you can do in lending is just get paid back, right? So then if you have any losses, you're in trouble. Trinity Capital takes warrants in all the companies they invest in, so that if you've got a moonshot, there's upside. They don't have a limited upside. So again, you have warrants, you have 17% loan to value, you have only 1.2% are on PIK, you've got insider buying from the CEO. I dug through all the BDCs because the prices were down and said, hey, is there anything here? And I think it's an interesting one. I mean, I'm not going to convince you to sell your land bridge, and that's fine. I'm not trying to, but it's an interesting one.
Now, this strikes me as something that Uncle Rick would do if he were an investor in software. This is exactly the same kind of play. I'm glad that you mentioned it's not as good as gold royalties and Landbridge. I'm going to take this clip and I'm just going to play it every day. I'm going to upload it to X. It's very interesting, mate. What I can't understand is just looking through, they've been diluting their shares. Do they need to dilute their shares then if they've got this cash flow coming in? Don't like that. Don't like that at all.
When you're trading above net asset value, you can issue shares and make more loans.
Okay, is Michael Saylor on the board?
No, but it's again above the net. Well, he's just buying Bitcoin. They're buying stuff with a yield. So again, your dividend goes up. Your equity goes up when you're diluting accretively. So again, because they have their net asset.
What about the new guys?
I mean, they still get a good dividend. They get the future accretive dilution. So yeah, but they are diluting to grow their book, but they're going to be constrained with, again, they don't do any syndicated loans. So there are very few companies out there that don't do any syndicated loans. This was the problem with, what was it, Sam Bankman-Fried and his giant blow up, is everybody said, oh, Sequoia is an investor. They must have done due diligence. And look at, all these people are investors. They must have done due diligence. And it turned out nobody did due diligence, right? He only had one spreadsheet. They didn't even have segregated customer accounts. There was zero due diligence. So they only do self-originated things. They don't have any syndicated loans. There's never this diffusion of responsibility problem that, I thought the other guy was looking. No, I thought the other guy was looking. All the recent blow-ups, you're talking about Trinity Capital or First Brands, they've been syndicated loans where everybody just assumed somebody else was doing due diligence, then nobody actually looked.
Okay, interesting. And the price has really taken a nosedive. We're down from recent high of $17 to $14.42. Market cap looks like it's trading roughly at 10 times stated net income. Net income has been stable. Again, where would this fit in the portfolio?
So if you like dividends, then it's an interesting one because it's got a pretty nice dividend portfolio. Okay. I don't have good enough hardware because I don't have the GPUs because they're too expensive now because of artificial intelligence.
Well,
There's
you
no
should buy
GPUs for the little guy.
buy the 6-year-old ones. Apparently, they're still good.
Oh, still
Okay,
expensive.
yeah. Well, mate, very good chat. Is there anything else you want to speak about?
Well, we've got Opendoor, LifeMD, Beeline Holdings, and Trinity Capital is interesting. If you like dividends, which my wife does, so I'll buy a little for her. But yeah, it's an Abacus Global Management. I have to buy more. Deploying $230 million of capital personally, and I had written this that this quarter, if they had deployed 150 million, I would have been happy. And they deployed 230 million. That's absolutely amazing. So
Yeah, and such
I'm
a
going to be buying more.
yeah, such an immature market as well. And I see that Jay Jackson, the CEO, and a couple of the other board members own more than 10% of the company. Okay, fine. The recent run up in price makes the aggregate value look more, but I think so much is lined up for a smooth runway, and I like their vertical integration as long as they don't go too crazy and start to go outside their scope.
The three co-founders and Jay Jackson is the CEO combined own a little less than 50%. And there is a fifth sort of a large person who owns a football team. And the five of them together own 58%. So there is a group of five people that can get in the Slack channel and talk to each other. So there's not really any risk of hostile corporate action. It's in that sense it's a controlled company, but it's an incentive aligned company, which is good. And the CEO, so his shares were gifted to him by the three co-founders. They didn't dilute the company printing new shares. They gave him the founders shares when they hired him. So that was just another gesture that the people in charge are very shareholder friendly. Oh, and they did start doing share buybacks. So the one thing about a growth company is not always huge cash flows to do share buybacks, but they started with 10 million, then they did 15 million, and last quarter they did 20 million of share buybacks. So they should see the dilution should be behind them. The CEO has said it would have to be a very exciting acquisition to dilute again, but their dilution days should be over. They're now in share buyback times.
Yeah, I like it. I'm just looking through the options market to see if I can get some degenerate but intelligent leverage. Yeah, some of the $10 calls seem interesting now. It's just dipped below $10. I don't know. What say you? Are we better off just buying the equity on this thing and holding it for a long term? I'm leaning more
Yep.
towards that.
So I had kind of limited myself to a 10% position size, but I'm going to break that now because I wouldn't have any real reason to limit myself. But after I hit my position size, I started buying some calls as well. So I have some calls. I've sold some puts. I have the common. I would do more, but with this recent drawdown, my leverage has gone up a little tiny bit. So I'm gonna, unfortunately, not pig out and buy more right now. I'm gonna cool my jets probably until we get a little more visibility on the Iran situation.
Okay, fair enough. Okay, sir. Fascinating discussion as always. Guys, links to Stephen's Substack and socials will be left in the description. He's a professor come hipster activist now. So I want to see you with some dreads next time we chat.
I can't let my hair. It's too thick. I know my it gets. I get terrible dandruff if I let it get any longer, which
Well,
is
dandruff is part of the territory with dreads, mate. So it'll blend right in.
yeah. No thanks. I'm gonna avoid that. I've got a cousin who's that way. I've got a cousin in Maine who's into that culture. I don't. He didn't get caught up in the Colombian fitness club,
Okay.
but he's definitely got the white dreadlocks. Unfortunately.
Well, we'll send him to LifeMD when he gets a lot of dandruff. Thanks for listening, guys. I'll catch you in another episode of the Royalty King podcast. Take care.
Thank you, Benji.